Chester went on Thursday, January 2nd, 2014, right where we left off last year. This S&P 500 index daily time frame, the overall kind of structure is still pretty much intact. Rising channel breakout dating back to May of last year. Bull market, rising 200-day moving average, rising and properly aligned. Daily chart moving averages, 200, then 150-day, 100-day, 50-day, etc., 20-day. We did get that kind of holiday grind higher, as you might expect, the drifting action. So the bull seems to be intact. On New Year's Eve, just a couple days ago, it looked like we were about to really explode to the upside and get things rocking even more than they had been. You could see just levitating above all of these major moving averages. And then today we walk in and we saw some notable weakness. You could argue this candlestick pattern right here, when you're in an uptrend and then it looks like you're about to get going to the upside with a reasonably potent green candlestick, and then the next day you come in, or the next session, and you get this even stronger red candlestick. You can see the sheer size of the candles. You could argue this is what's known as a bearish kicker candlestick pattern. Again, what gives you that fake out, kind of the abrupt change in trend. It's still very early in the game to say, as we saw throughout 2013, you had to be careful. I always gave those caveats. I know it's not fun to kind of always qualify statements because you love to make the big bold call, but I think that saved a lot of potential traps last year by not just assuming that because the market went higher we had to top out imminently. You were on watch for certain technical patterns, but not only did they last year fail to resolve lower, but oftentimes they were nasty bear traps, which ultimately led to the next leg higher in the bull. We saw that many times. You had to be disciplined if you were taking your shots on the short side. And I think you just have to keep that in mind when you see, again, many people might call this, especially if they're candlestick inclined, the bearish kicker. We were levitating. We were quite extended. Just look at price from Tuesday, New Year's Eve highs up at 1849 down to the 200-day moving average, a couple hundred points lower. That's very, very steep extension. And remember, price has not tested 200-day moving average in about 14 months now on the S&P. It's a very rare circumstance to arrive at, and the presumption would be typically that we're going to revert here. It doesn't mean price has to come crashing down to 1680. It just means this relationship, this, let me draw a line here, this steep relationship from Tuesday, New Year's Eve's highs, the most recent all-time highs in the S&P, the white line that I've drawn down to the 200-day moving average, it should revert somewhat. So again, we'll see if the new year brings in more of a reverting kind of relationship, or, and that's why we're going to go through actionable ideas, if the blow-off or the bull run is just going to continue unabated, if it's just going to be so powerful and potent. And if it's true, the bulls are arguing we're still in a hated bull market and, momentum is too strong. If that's the case, so be it. We're going to be nimble. We're going to adjust. We're not going to have a bias that's going to get us in a world of trouble when you see a market that's been levitating like this, I think, for this long. So I want to start off the video on that note. Yes, here we did see some notable weakness today in some parts of the market, and overall the indices were not impressive. I mean, the Russell 2000, the high beta small caps, here again, that's a line I drew in my weekly strategy session. Just note the sheer extension away from the 200-day moving average. You could see very extended, and the presumption would be we will get some kind of reversion or relationship here, but again, you have to be nimble enough to adjust if the bull continues higher. NASDAQ, again, doesn't look quite as bad as the Russell, but overall, again, still quite steep and extended, kind of levitating up here as well. It doesn't mean it has to top out, but it does mean just kind of have your guard up, with some of these names that have also been levitating, like your Amazons, your Googles. There's nothing wrong with them other than the fact that they're just so good. The contrarian might say, they're so good, maybe they're starting to get bad because they're just levitating up here and they really haven't had a proper kind of sharp shakeout in several months at least. Priceline.com is one of those names that started to circle back today. Apple, kind of neutral on Apple, below one, even though this reversal is still confirmed. We played this breakout higher below 552. I would get quite cautious. I would expect probably a retest of these lows. So let's see if Apple can kind of hold the line here. Now, the real action today, of course, was in the solar CSIQ. I noted inside 12631 trading service, this 30-minute chart, we saw the three white shoulders candles, three huge overlapping green candles on the 30-minute time frame to begin the day, and then it pushed higher yet. So I was looking for maybe a slight pullback. I didn't even get that. It just kind of paused and went higher. So be it. You know, some of these things are going to run away from you. That's how solars trade. Other names like YGE, just absolute monsters on that front. Excuse me here. Looks like my charting software was frozen, but JKS would probably be another name to have on the list. All the solars, they typically move together. So just, again, keep them on watch. They're going to be aggressive, and if they gap away from you, and you're not looking to kind of chase them per se, given the many head fakes we've seen in them over the past couple months, the fits and the starts, I don't think there's anything wrong with taking a pass on them. But let's get to the overall picture. The TAN ETF, remember, this is the mini bearish rising wedge. We know in the weekly chart it kind of resolved lower for correction, but keep in mind that this might be the extent of the correction for the solars. This inverse head and shoulders bottom dating back to last 2012, really, it's still intact. It broke out, it bull flagged last spring 2013, bull flagged again in the summer, pushed higher yet into the fall. First time it's tested its rising 20 period weekly moving average, dating back to last April, when it still hadn't even broken out yet from this inverse head and shoulders bottom. So I'm really keeping an open mind to the idea that perhaps solars might have already corrected in recent months, and now it's off to the races. If that's the case, again, no bias. You adjust, I think, with the tide, and I think you have those names on your radar, and then it just comes down to your risk tolerance and your preference as a trader. If you're not comfortable chasing extreme momentum like the solars can do, then so be it. But they're very tough to be short, put it that way. Either you're long and you're in them and you're riding them and you acknowledge that they're high beta, or you're kind of on the sidelines. So I think that's pretty much the way you play solar and the way you approach it. Other names, look, LinkedIn, Netflix, obviously not too inspiring today as far as your marquee leaders here. Tesla just kind of did nothing today. I'm kind of neutral on it. Above 145, cautious below it, and I think it's still kind of trying to find some strong hands here. Facebook kind of did nothing today. Twitter, pretty good today. It's a beast. Again, I would not be shorting it. See, a lot of guys want to short Twitter. I just don't see the short trade there yet. It looks like it's an IPO under accumulation, buying by institutions. At the same time, usually IPOs need a couple months to kind of form a real chart. VJet, I believe there were a 3D printer here. I believe there were buyout rumors surfacing. A pretty nice base here. We'll see if we can get above 44.50 today's highs. Then I think you got a long setup there. MCP, BlackBerry, some of these losers from 2013 now starting the year very impressively. BlackBerry, I like above 775. Would have that on watch into tomorrow. Coffee, nasty New Year's Eve sell-off. Tried to regroup today. Needs to get above 22 and especially 23. Natty Gas, great buy volume. Remember, we talked about this breakout. We played it briefly a couple of months ago, and now we're just looking for our next entry point. I'm still constructive on Natty Natural Gas, UNG ETF, playing UGAS, the triple long ETF, if you're looking for action into 2014. So I just want to see some more strength back above 21, 21.50. Crude oil, not good. Bearish rising wedge, broke down. I think crude is an established downtrend here, and there's definite risk of another leg lower, in my opinion, just based on what I'm seeing in the chart. Silver, again, we've been talking about that. New Year's Eve was vicious selling, but it looks like a bear trap now. From this failed move lower may come a fast move higher. We know silver, gold, and especially the gold miners, vis-a-vis these lows, vis-a-vis the summer lows, they're bullish RSI divergences. We've been talking about it. They take time to play out. It's a steep, just like the opposite with, let's say, the Russell 2000. With the stretch rubber band to the upside, the gold miners have a stretch rubber band to the downside. So sooner or later, especially when you get those divergences, you get surprises to the upside because you get this reversion, and you can see the extension from 200-day down. You can see to price of late, but price hasn't touched the 200-day moving average on the gold miners since basically this time last year in a full year. So even if you think gold miners are going out of business and they whatever your bearish argument is, you can still get as a mechanical kind of thing, a relationship to 200-day moving average, bounce up to it, and then you can go to zero and short it. Just wanted to point that out. Into 2014, I'm still looking to get back involved. We had some nice trades with Nugget, the triple long ETF in 2013 inside 12631, and I want to keep that open mind that now might be time to strike yet again. Some ideas into tomorrow: EBS, EHTH, I think pretty good technical setups, good action today. Williams Sonoma, WSM, ARII, heavily shorted rail card play, basing reasonably well here. HCA, we had a 126, remember, point this one out. Didn't like that fade late in the day, but the weekly chart still constructive. Sorry here, it looks like my charting software has been freezing up a little bit today. But again, overall, keep some of those China names too I meant to mention. VIPS, one of the better looking ones. YY, Yoku, YOKU. Again, so a bunch of these China names performing well. Let me check out on HMIN, HMIN, still like this base over base action. So it looks like a bunch of these high beta China names, in addition to the solars, are really kind of where most of the action was today. Other than that, again, let's kind of respect the market weakness. A lot of marquee names from 2013, like Starbucks, Ford, kind of pausing here or showing some weakness. Dunkin' Donuts looks like it might follow Starbucks down. So again, that has me kind of holding off on new buys until the market can show us that at least it's going to kind of regain its footing, and today wasn't necessarily a bearish kicker.